Hey, what's going on, guys? Today I wanted to just share a few mistakes that I see people make when it comes to yield farming in DeFi. And a lot of times it comes with using leverage or more advanced strategies. It could cost you a lot of money down the line. I've seen a ton of people just using these strategies and end up losing a lot of money because of it when they're not applying it properly, right? And again, none of this is meant to be financial advice. I'm just sharing what have helped me so that hopefully it helps you as well. So one of the most popular strategy in DeFi is to lend out some assets like either ETH, wrap stake ETH, wrap Bitcoin. Some of these assets pay a small yield, like for example, staking ETH pays like about 2% and then lending it out pays about 1.5% currently. But wrap Bitcoin does not pay any. And the main goal for a lot of people is not really to earn a yield on these assets directly, but to borrow against them so that they could use the stable coins they borrowed to yield farm, right? For example, I lend out some ETH, I want to borrow some USDC. I could put that USDC into different stablecoin farming protocols to earn a yield, or like the leverage loops with different stablecoins, or using different platforms like Pendle to earn a yield, or just putting it into a liquidity pool with ETH paired with USDC, right? In that case, it's a leverage long position. And a lot of times we are being long for this type of position. That's why I call this strategy the bull lever. But a lot of people make the mistake of borrowing too much. You can see with wrap ETH, the max amount that you could borrow is 80.5%, but you will be liquidated if the borrowed amount goes up to 83%. So if you're lending out some ETH and then you're borrowing some stablecoins against that, stablecoins typically don't rise in value. So the only way you would get liquidated is if ETH drops in price, right? But the problem comes when people are borrowing too much. Let's say you start off with like 50% LTV, but then ETH started declining in price, then you could potentially get liquidated if that happens really fast. We saw during October of last year, a lot of people got liquidated because they borrowed too much, or they're using perps, or they're using leverage with perps, right? And with ETH and Bitcoin, in my opinion, the maximum amount that we should be actually using is around like 30 to 40%. You could go even lower to keep things safer. You don't have to go crazy with the leverage, especially if you guys are putting a bigger chunk of your portfolio into these positions. You don't want to be like putting your entire portfolio into that. So that's the one thing to keep in mind. There's always a scenario where the price crash. And the second scenario where the risk comes in is if prices keep declining for quite a while, right? We saw with Bitcoin, prices have been trending down over the last 6 to 12 months. Same with ETH. ETH dropped by 60 something percent over the last year or so, right? So you got to be prepared for that scenario. It's pretty easy to avoid over leveraging when you're first applying the strategy because you could calculate the LTV, take out 30, 40%. But what a lot of people don't think about is if ETH or Bitcoin declines in value, how are you going to unwind that position? So that's the second mistake a lot of people make. They don't think about unwinding their positions. And there's two main methods that I like without actually selling out of my position. The first one is pretty simple. Let's just say you're yield farming ETH to USDC with the borrowed capital and ETH price has been dropping. What's likely to happen is you're going to be ending up with a lot more ETH or fully converted to ETH to the downside. If I put USDC into a pool, let's say the range is from like 2,000 to 3,000. As price drop below 2,000, I'm fully into ETH. What I can simply do is withdraw that ETH and then deposit it back into that lending and borrowing platform to increase my liquidation buffer, right? So then maybe my liquidation point would move from like $1,500 all the way to $750 or lower. And then the second method is simply to not put your entire portfolio into that strategy, right? I've seen people just put their entire portfolio onto Aave or onto Morpho, onto different lending and borrowing platforms, borrow against that, and then they're caught in a bad position when prices started trending down. There's always added risk when you guys are using leverage. Nothing is ever like truly free in DeFi, right? There's always that risk of getting trapped in those positions. And if you're putting your entire portfolio there, you don't have other capital to unwind that position or to add to that liquidation buffer. If I have some positions that are maybe yield farming crypto to crypto pools or like just crypto to stable pools without leverage, I could always withdraw from those positions and then add it as collateral. or if I have some stable coins left, I could repay the loan as well, right? So that's really simple. Always have a plan in place to unwind your position. And this goes for like other strategies as well, whether you're using like hedge LPs or you're farming crypto to stable pool, crypto to crypto pools. Have a plan in place for when the prices go down or go up, then you're going to be prepared for most scenarios, right? So don't go into a position without a plan, especially if you guys are risking real capital. And then the last mistake I want to talk about is over hedging your LPs. So let's just say you like to run a tighter range setup. I know some people do prefer that, either using a ladder strategy or they just want more cash flow out of their positions, right? I personally prefer a wider range setup, but let's just say we go in a little bit tighter than what I normally would. Maybe the minimum range is at 1250, max price is at 2500. And I'm using the Dripper simulator here. You guys have access to this if you grab a subscription, or you could use the other free tools I share on my channel as well. But let's say I want to hedge my LP with a perp short. I could add it here and then add a short. And then what a lot of people do is they're going to be over hedging their position, right? I could see currently I have about 0.215 ETH in my position. So if I hedge with a 0.25 ETH position here, you're going to see that the equity curve here is going to decline in value as ETH rise in value, right? So if ETH goes up in price to 2,500, I would actually lose some money here. So I could increase my leverage here too. If I want to do like 2x leverage to make it more capital efficient, I could do that. But let's just say I want to set a stop loss at the upper range. So this is where a lot of people make the mistake of over hedging. It's a good idea to have some sort of plan in place to rebalance your position if prices move up. So one way we could do that is to just set a stop loss for our position. And using different platforms like VFAT, you could also set like an auto exit order to exit your position if it goes to the upper range as well. What I like to look at is this stop loss, profit and loss right here. So right now it's saying that I would lose 7% of my capital if the price hit the stop loss. And then if I set the take profit at the bottom range, 1250 here, I would still lose a little bit of money here with the hedge, but it's still going to be less than if I don't hedge my LP, right? So 7% on each side, it does not sound like much, but it does add up over time. Even if you guys are just using like 1 to 2% loss, when you are hedging your LPs, it's going to eat into your profit margin, right? What I prefer instead is to try to get the stop loss number to be close to break even. So what we want to do is adjust the size of our short. So if I drop it to 0.2, you can see that on the downside, I would suffer more drawdown, but on the upside, I would lose less money as well. So that's still not quite enough. So maybe I would do 0.15. That's close to a 2 to 3% loss. So maybe 0.12 or just 0.1. You can see I'm close to break even here at this stop loss point. So on the downside, I would suffer a 17% drawdown. This is if ETH reaches all the way to 1250, right? And in my opinion, it's not as likely that ETH is going to go down, so I'm happy with the drawdown. But the reason why I like to set a close to break even on the upside is because it's better to not lose money to the upside compared to losing money towards the downside, right? I would rather have a deeper drawdown. The reason why is if the price keeps going lower, you could always switch to a spot ETH position. You would have been able to buy more ETH than where the ETH price is right now, right? Let's say I start this position with $1,900. This is where ETH is right now. I could only buy one ETH, but if I run this position and ETH drops all the way to 1250, maybe I would be able to buy like 1.25 ETH or a little bit more than that. But if the price keeps going up and then I lose capital on the way up, then there's less places that I could deploy my capital into, or I can't really rebalance into that position without locking in some losses. In my opinion, over hedging is a mistake if you guys regularly use the hedge LPs. And before I hop off, there's another mistake. It's just using these strategies at the wrong time. This is probably the most important thing when you guys are yield farming. On my channel, I've shared a bunch of different strategies, the pros and cons behind it, and also when to apply it. A lot of people don't talk about when to apply these strategies. For example, if you guys are just using a straight up hedge LP without that lending and borrowing portion, then you should not really be doing it when prices are cheap already, right? Because what we're essentially doing with hedge LPs is we're trading up some upside for less downside while we're earning yield in the process. And that works the best when prices are kind of high already. If you're considering hedge LPs, it should be on different charts, like for example, the hype price chart. If the ETH price chart starts to look like this, it's a much better risk and reward if you guys start using hedge LPs, right? Because we never know if prices start to reverse, it's going to draw down by quite a lot, but you still maybe want to hold on to some of your positions, earn a yield on it, then using hedge LPs in those scenarios are better. And if you are using that bull lever strategy combined to the hedge LPs, applying it right now is actually pretty good still. You're protecting your downside, right? You don't have as much upside compared to people who don't hedge at all. But at the same time, with the bull lever setup where you're lending your assets out and then you're borrowing stablecoins against that, your biggest risk comes from that downside drawdown. So applying it right now makes a lot of sense. Same with the bull lever. If you're straight up just lending your ETH and then borrowing USDC and then using that USDC to yield farm ETH to USDC, or doing something similar with Bitcoin, applying it when prices are cheap makes a lot more sense than when prices are already high and maybe a potential breakout is coming, but then the price could potentially draw down as well. It's a lot riskier to take on a ton of leverage when prices are high already compared to just waiting when prices are cheap. Then you're borrowing conservatively against that, right? You should not be like, for example, borrowing like 40, 50% against your capital when the prices are trading at its all-time high. It's just too much risk in my opinion. And when there's a big drawdown like this, then you're going to suffer a lot. Keep in mind that if you are in a leveraged long position, your upside is accelerated. You're going to have more upside, but you're going to have more downside as well, right? So it makes a lot more sense to kind of amplify that upside when prices are cheap and the risk and reward is good, rather than trying to do that when prices are high already and then you risk losing a lot more money. If you're considering like delta neutral strategy, hedge strategies, and stuff like that, those tend to be much better when prices are high and then you maybe hold a bunch more stable coins compared to where maybe a lot of your capital is deployed into crypto holdings already, right? So hopefully it was helpful. If you guys have any question or if you want to see anything else, just let me know down below. If I think it's going to help a lot more people out, I'm more than happy to make these. And check out the free course down below as well. Let me know what you guys think. Thanks for watching. I'll catch you guys on the next one.